All right, so the models that are running here today for me are different than yours. When we train the machine learning system, we tell it for every single bar what actually happened, or rather we use what actually happened as a way to train the machine on what to do. And we define success as a move that is 3 times the bar height. So for the NASDAQ, that means 30 ticks. All right, so 30 ticks in one direction before 10 ticks in the other. And so if you look at that bar right there, the data that's fed to the machine is, this bar here, meets the long target because it goes 30 ticks in one direction before it goes 10 ticks in the other. Next one also. And so then what we do is we give the order flow data to the machine for these bars, and it makes a prediction, and then it compares that prediction to what actually happened, and then it uses that information to improve until it gets to a point where it's learned that the order flow patterns that it sees in these bars are successful long trades. Okay. But the choice of 30 ticks it's not arbitrary, but it's choosable. It could be something else. And the thought was, well, what if we used a longer target further out? Would we get a sort of a higher quality prediction? And so the models that are running today are double what they have been, what the production model is. All right. So instead of 30 ticks is a successful trade, it's 60, and for the ES it's 24 instead of 12, and for the oil it's 48 instead of 24. All right, and I've been running a bunch of tests on that. It doesn't test out as well in normal conditions, not nearly as well. And I have the spreadsheets I can show you to show that. So that like in the NASDAQ, under normal conditions, meaning normal would be defined as overnight ranges that are less than 60 points. The model that we're using is clearly far superior, like 4 times far superior. But one thing I did notice is that you take far fewer trades by doing that. In other words, the conditions that the market has to meet in order to take a trade are stricter, and as a result, you've got to take you end up taking less trades. So that by itself is a pretty interesting data point. All right, I thought that perhaps with greater stricter requirements, with a target that's further out, we would get better performance in the volatile times. That's not the case. It's just as bad as the closer targets. So just that sort of lends credence to the theory that the increase in volatility is really equates to an increase in randomness, and it kind of doesn't matter what the patterns are so much in the order flow, because the volatility is so high, the randomness factor is so high. All right, but what it does have me thinking about is there's 2 things. The first is that, well, if I end up taking fewer trades with a target that's further out, is there I chose 60 ticks just because it's double. Is there a sweet spot in between 30 ticks and 60 ticks where I end up taking fewer trades that still generate similar profitability to the current 30 tick target method? It's not really 30 ticks, it's 3 times the bar height. It's kind of the way it works out. And it's really not even that. It's when you calculate the success criteria using 30 ticks, what you end up with is 50% of the time is no action, is the market doesn't do either case, it doesn't go up or down, and then the other 50% of the time it meets the target one way or the other. That's where 30 ticks comes from, and it's true for the other markets as well. But it occurs to me, okay, well, what if you chose a different one? So there's some interesting testing there to do there, some research. Can we get similar performance with fewer trades by using different targets as success criteria? So there's that. What you just saw me doing a moment ago, before I started chatting here about this, was prepping the system technically for what we talked about last week at the weekly update, which is where you, the user, can define what any criteria you want, and then just call for a prediction. Okay, so that's the test you saw when you logged in this morning. What I was doing was demonstrating that it was technically feasible, and it is. And so now it's a function of some engineering details. The easy way out is just to say it's too volatile, don't trade it. But again, the opportunity is too good to pass up. Let's see if I can figure out something.
order placed.
So there's an order placed long on a failed breakout short. It's a scary looking trade if you ask me. And so what I want to happen here is I need to come out of this with a clear rule on, okay, well, what do you do when the markets get this volatile? Do you stand aside, or do you do this, or do you do that? All right. So the opportunity is here. Let's make use of it. It's looking more and more like, okay, when the volatility is X, then just either A, don't trade it, or B, drop to just breakout trade, something like that. And let's define what X is. In the past, X was 60 points. I don't know if that's still the case or not. So a quick stop there in the NASDAQ. Maybe just looks like just a hint too soon, right? So now long and hit first target and trailing by 5. Now it's scratched. So a good example, we've seen this a couple times where you went one direction, you got tagged, and then you immediately go the other way. And if you also get tagged, then the request comes in, well, don't let it do that. And kind of the things we talk about is that's really what the machine is good at, is just to make that decision without emotion. So you need to just let it do that. In these conditions, if it's happening too much, that just means it's too volatile. In normal conditions, when you see that happen, you really want it to do that. So if you see, something I think you'll see fairly often is you'll break the highs or something, and the market will get long, system will get long, and you'll get stopped, and then it'll almost immediately go short. And you wouldn't do that as a human. You'd still be, on your 2-minute drill, or just reeling from the fact that you just took a loss. But what's happening there is the market's testing the high, and it looks like it's going to succeed. It doesn't, and then you get a signal to go the other way. The machine just takes it. So that's kind of what you're after. The whole idea is to remove the human emotion from the equation. So $40, so 8-tick gain there on that little move long in the NASDAQ. All right, so long now in the NASDAQ on I don't know what that is, failed pullback and trailing. The target is mechanically set at way out there, 80 ticks, and we're just trailing by 20 now. So order placed long, but it's gonna cancel because we didn't get filled. And by the time this, yeah, as soon as 2 bars draws, then it cancels the order for us automatically. So we missed that one here. Another gutsy long here in the NASDAQ. It's a failed breakout short long. Wow, look at that. Look at how jumpy the market is. So at first target moved to -5, entry -5, and now trailing. This is really as ugly looking here with these gaps. It's a failed breakout short, so this bar here is breaking this level right there. The prediction is failure, and so we get long. And now we're up 10 points and trailing. All right, so nice. Not quite 10-point gain. Another order long there in the NASDAQ on a, actually can't read that code. Markets are super whippy. Right above 6,600. Huh, almost got me there, but then came back and hit first target. So stop moved to -5 now. I'm looking for 20 to get start trailing. Yeah, when things are less predictable, the big players pull out, and that's why it thins out like that. All right, so at 20 ticks of trailing now. You can see, we can see as humans, you're going to have to clear that level. That's what's going to get tested. And we didn't, so small gain there. All right, so filled long here after we ultimately did kind of break through that level. Pretty deep pullback. So at first target, so -5 now, and then on the left, in the lower left here, this is in sim. I'm running 2 different versions. The upper right is live. This one's live here. We're looking for 20 now to start trailing. Gosh, it's really whippy. All right, so 5 tick loss. I've hard coded a value for that. You know, what's enough? We're long here now in the NASDAQ. And so what we're talking about doing is, instead of having some hard-coded value that defines the success criteria for the machine to use to learn on, make it variable based upon the volatility of the market for that day. All right. So instead of 30 ticks represents success, or 60 ticks represents success, the amount that represents success to the machine as it learns will change based upon either the average daily range or based upon the overnight range, which is something that I use. Okay, so we're trailing now by 20. Markets are, if you look at that market, it's really making these, we're not getting nice breaks and runs. We're getting sort of deep pullbacks every time here. This trade's at scratch though, so it'll be what it'll be. Now it quieted down. That's a good question. Where is that? Let's take a look and see what. So there's an obvious level there we just tested, 66.15, and the high is up at 21. Target is just mechanically set way out there above the overnight high. Actually, you need a nice break to get there. The market is pretty choppy here. It's choppy, just angled up.
NQ order placed.
Okay, so that's a placed order in the. This is sim down here in the lower left, off of. I can't read the code. All right, so I'm stopped out for a small gain in the live account. All right, so here we are at the end of the day. Let's review what happened here. I think the last live trade was this pullback to a stop right there. You can see that's just immensely painful. Stopped out by a couple of ticks. This is a 20-tick trail running before just a beautiful run here. And unfortunately, we don't get a signal on, let's see, we would have got stopped out there. So there's a potential, there's a potential signal there or there on that this pullback behavior. These are all going to be in the too aggressive category. So it is what it is. It's just life. A 20-tick trail with an 80-tick target is what I'm using. So let's continue here. Stay out of the chop nicely here. And then try to get long here on a predicted failed breakout short. That's just wrong, right? So we take our 10 ticks there. And then looking for continuation short here, which gets stopped, and then you immediately turn around and get long for a small gain. Get long here on a failed pullback short for a nice gain. That's 7 3/4 points. And then, wow, this is another failed breakout short here, this signal right here. That looks like a pretty fortunate entry. The market was falling hard, and we got the slippage actually kind of worked in my favor there. Otherwise, that could have been a stop. Note the 102 right there, though. It's seeing that turn. So that was 6 3/4 points. A 10-tick stop in here. And then this, here's another failed breakout short. So the market's breaking lower. Prediction is failure. You get in right there. And then you get a 20-tick run. And look, and you can see I still got out way too soon. That's a 20-point run. That's 80 ticks. That's a $400 run right there. Still got out too soon. And then last trade of the session is a pretty aggressive pullback long. That actually, that's a failed. What is that? 121. I'm gonna have to go look that up. It looks like an aggressive long pullback. In any case, takes a stop there. So final result is 835, and this brings to mind some discussions that we were having really over the last couple of days and have started to coalesce in terms of understanding, okay, well, just how do I deal with this volatility? And I feel like I've got some guidelines now on what to do, just in terms of looking at the market in the morning, seeing what the range was overnight, and then making a decision on how to proceed. I've used that particular approach for years in the NASDAQ, just as a discretionary trader. Look at the overnight range, and that's why you see on this chart here, you see this Globex high line, this white line right here, this line right there, and then the low is also just plotted by the software. And so I look at that and see, well, how big a range is that? And a couple of years back, actually more than that, several years back, we had just the first of these bouts of crazy volatility, and we developed this guide called the NQ Volatility Assessment Guide, and we use that to, what we would do is look at the overnight range, and from that, depending on how big that range is, make a decision on what the expected volatility would be for the day, and decide how we were going to enter. So really the same thing applies to the machine learning system here is what I'm seeing. It's just that the values are different because the machine can do things that I can't do as a human. Just in terms of the speed with which it can execute, and the ability to take a trade immediately after taking a loss. The machine can do that cleanly, and I as a human can. I can't be sure that I'm making an objective decision under those conditions. And so, my basic view here is, under the current conditions, if the overnight volatility is more than 100 points, which is, by the way, just an insane value, if it's more than 100 points, then in the NASDAQ, then I'm either not going to trade, or I'm just going to drop to like breakout codes. Just take breakouts and see. What I've seen is you can do okay. It's still the reality is, when the volatility goes up like this, the unpredictability goes up, or rather the amount of randomness in the market goes up. And if you just think about what that means, no one in the world, no system, no person can predict the roll of the dice. And that's kind of what's happening, is when the volatility gets that high, you're just rolling the dice. So if it's between, say, 60 and 100 points overnight, I'm willing to run the system, but I may look at it the first 5 to 15 minutes and see how it looks. If it's really whippy or jumpy, then I'll stay out. Otherwise, I'll just let it go, because this is the kind of result you can get on that day. 41 points, 835 gain. But you have to recognize that there's a much higher likelihood that you're just going to get whacked, and it's generally really, really quick, right? Usually, it's the first 2 or 3 trades and you're done. It's like ripping off a Band-Aid. And then if it's below 60 points, then there's no hesitation. Absolutely, I'll trade this. I'll trade it. In fact, I like to see that sort of between 30 and 50 point overnight range. Then I can expect decent movement, and the system will take advantage of that. The replay data very clearly shows that. So those are the guidelines I'm working with right now, and then we'll kind of see how things go here. I'm hopeful that the markets are starting to settle down. I would not expect them to just go back to normal. If you look at the daily chart here, what you can see is these arrows are from when I was discussing with the members in the room this morning. When this happens here, you got a lot of people that were buying, a lot of people that are leveraged, and all that deleveraging is happening. And then we climb back up, and everyone thinks it's okay, but then here it is again. And so this kind of thing, it takes a while to play out. It's not gonna very quickly go back to normal. I mean, we don't know what that new normal looks like. Hopefully it looks more volatile than the kind of the complacency we saw most of last year. That would be good. But too much volatility, you can see, is just as bad or worse. Okay, so that's it for today. We'll see what tomorrow brings, and I'm going to use those guidelines I just described, and we'll see if we can kind of make it work for us, make the volatility work for us instead of working against us.